Bill Greiner, the third quarter was the worst for stocks in 4 years. So let's look ahead. What do you expect from the stock market from here on out?
We believe we're in an environment right now where we're going through a cyclical correction in the market, and we think this correction probably has a little longer ways to go. There's a lot of anxiety running through the market right now. Witness, for example, what's going on with Glencore in London and what kind of potential effect that might have in the trading pits on the commodity side of the equation, which feeds into anxiety on the emerging markets if nothing else. So we're particularly concerned over the next few weeks about continued contraction in the equity markets. We believe, though, that this contraction will probably be retained or contained to a maybe 30, 60-day period of time, maybe 2 or 3 months, following which time we expect the secular bull market to get back on track. We expect next year to be a profitable year for the equity markets.
Well, not helping with the volatility of late is I guess you could call it indecision by the Fed, or postponing their decision to raise rates. So what's your view about what the Fed will do and how investors should view that?
Well, first, I was a little disappointed, but Janet didn't give me a call to ask my opinion as far as what they should do. I was expecting them to raise rates. I think they had an opportunity to do so, and indeed the markets felt the same way because the markets have swooned a little bit since that period of time. I believe the Fed is going to raise rates this year, either in October or December, and I realize that both months have technical issues as far as why the Fed wouldn't raise rates. I think something else to consider is the Fed is probably not going to raise rates through the Fed funds mechanism. They're probably going to do so mainly through the reverse repo markets. So I think when people start talking about the Fed funds rate, it in and of itself may not be particularly managed by the Fed, but start looking at other short-term interest rates following the Fed move to the upside.
And you mentioned emerging markets. Emerging markets generally get hit pretty hard when the Federal Reserve here raises rates. So what's your advice for investors who maybe want to put their toe into Chinese or Brazilian stocks right now because they've been hit very badly?
Well, that sticking your toe in a hot bottle of water or a hot tub of water at times isn't really a smart thing to do. We've recently, over the last 90 days or so, have been raising cash out of the emerging market space for our clients. We think that, in general, what's going on in the emerging markets is going to be temporary. We believe that that move on the downside we're seeing in the emerging space probably has a little further to go. Keep your eye on the commodity markets. We probably need to see a bottoming in the commodity markets and also economic activity in China. Data that you can trust, not necessarily the data from Beijing, but electricity utilization rates and such out of China. I think that's another indicator that the emerging markets are probably trying to reach for a bottom.
And speaking of commodity markets, the problems in the oil patch really pulled down high yield last winter. So what's your view of high yield right now? We hear a lot of people say it's the canary in the coal mine. Carl Icahn saying it's dangerous. What do you think?
We wouldn't chase it. We think there's better ways of reaching for yield if you'd want to do that type of activity. We do feel that there's some real teeth to the issue on the standpoint of energy credits, as far as junk credits, high yield credits. We think that Samson Energy bankruptcy announced 2 or 3 weeks ago is kind of the tip of the iceberg, and we feel that there's probably more coming. So we would hold off on putting money to work in the high yield space at this stage.
So if you need yield, where would you look for it?
Start thinking about tiptoeing into the MLP space. The MLP space right now is trading the average yield on the index, Greg, is about 620 basis points above the 2-year Treasury. And going back over the last 20-year period of time, there's only been 3% of trading days where MLPs have yielded that biggest spread over 10-year Treasuries. So we feel that this area has been pretty much washed out, and it may continue to see some downside pressure with oil prices going down further. But nonetheless, we think values are starting to poke their heads above the water there.
And what about REITs? You have a view on REITs?
We do have a view on REITs. We are underweight REITs in our clients' portfolios, have been for the better part of a year or so. So we're maintaining that position right now.
All right, so bring it back to the beginning. If you want to choose some stocks in this environment, which I know you're a little bit bearish on right now, before we see a better 2016,
right,
which stocks or sectors would you opt for?
Surprisingly, we're more bullish and more green light, if you will, on the U.S. small cap markets. We think over the next 4 quarters, if there's going to be adjustments to the downside and earnings flow, it's going to be with companies, obviously, that are the international companies, those companies that have a tremendous exposure to overseas operations, because we think that's the smoke from the distant fire theme. That's where the real fire is these days, as far as economic and market risk is probably radiating from the international space. So if clients want to put money to work in the equity market, and I understand why they would right now because of the correction, probably look at the idea of putting money to work in U.S. small cap.
All right, well, thanks a lot, Bill.
Pleasure. Thank you, Greg. Appreciate it.
And thank you for watching The Street.